All right. Hey, good morning, everybody. Thank you for dialing in. As always, most people watch this thing online later in the day when we send a link. So, for those of you that are here, I'm glad you're here. And if you have questions, use the chat function in the GoToMeeting app, and I'll do my best to get them answered for you. We're going to look at several things today, so I'm going to jump right into it, and we'll be out of here in 20 minutes or less, hopefully. All right. So the reason that we're here, for those of you that are listening for the first time, we're here to get a little bit of clarity because we're inundated with noise constantly. You hear it in the coffee shop. You hear it when you just pass by people in the supermarket. And particularly today, you can hear the disappointment, depression, and fear coming through people's mindsets. And what we're going to try to do is add a level of simplicity to our marketing plan by being objective. And when we do that, we can maximize our time. So when we look at what's going on in the world, the big headline from yesterday is that we had POET idling ethanol plants. I don't think that came as a shock to anybody. We all knew that likely that was going to happen. We all know that oil under 30 is a train wreck for ethanol, and it really puts our entire industry on the ropes. Tremendous uncertainty in the marketplace. I'm not going to beat that horse at all. Everybody knows what's going on with in relation to the virus. Most of us are on lockdown. What is interesting is China is replacing hogs at a fast and furious pace. So if you think about China, China agriculturally is where we were probably 50 years ago. So you had lots of small herds throughout the countryside, and now because of the swine fever, China is moving towards a more commercialized setup. So they're investing heavily in a few state-owned businesses, and they're going to consolidate all of that because they think that's going to increase their biosecurity. It's going to increase a lot of things about their production lines. That's also going to shift the marketplaces away from the Chinese wet markets to a more refrigerated based market like we have here. Um, and and ultimately that's going to make them more efficient. Um, this week, or maybe it was last week, I don't know when, but China brought in lots of hogs by airplane from France. So they're investing heavily and they are replenishing their hog herd. So that's very bullish for soy meal and soybean demand. So that hasn't been reflected yet in the purchases, that hasn't been reflected in the price, but it's something that's brewing under the surface and something we want to be aware of. Domestically, we've got packing plants that are shutting down, adding to the uncertainty. Workers don't want to come to work because they don't want to get the virus. We're just getting more complications as things go. And if we're getting those complications, then you know that other countries are getting them too, even if those complications haven't yet hit the marketplace. And then the last thing, we are to the point of the year when planting matters. So I think we're going to see, after tomorrow's USDA report, I think we're going to see the market shift to more supply side trading, where we're going to be less focused on the demand equation and more focused on the supply. Think of it this way: if we all think that a 4 billion bushel carryover is going to happen in corn, you you have to have terrible demand, which we all agree we have, but you also have to have all of the supply in place. And there are two huge questions on supply today. You've got how many acres are going to be planted, and you've got what's it going to yield, right? No matter how bearish we get, we can't isolate ourselves from the fact that supply is an unknown. So the market has been trading known fundamentals that are terribly bearish on corn, right? Ethanol, ethanol, ethanol. I think it's going to shift to start trading the unknowns, which are supply and acreage. which are yield and acreage. So we're going to look at what the charts are telling us here because it's really telling us something important. But before I do that, I want to show you this spreadsheet. Hold on just a second here. I gotta pull it up. Last year, if you remember, we started talking about preventive plant acreage pretty early on because we had a lot of the Corn Belt that was underwater. Now, we're not as extreme this year, but it's still relevant. So coming off of last year, you have a lot of farmers that got burned by not taking prevent plant last summer. The market was recognized on May 13th that too much of the Corn Belt was having difficulty planting. And so it started doing the math, and the market recognized that it needed to put a premium into the futures to induce the guys to plant. And then the USDA got nervous and threw more MFP payments and threw more policy things at the farmer to really induce the planting. We're not that extreme this year, but we do still have lingering effects. And the lesson learned from last year is that if you didn't take prevent plant, you got burned. So this year you're going to be quicker to take it, which means we may need less extreme weather. So the point is that in the Corn Belt, there are areas where prevent plant is an option for farmers. And so the question is what does that math look like today, and where do we have it? So here's our prevent plant spreadsheet. We want to look right at this column here, because here's what matters. If you have $550 an acre left to spend, so I'm assuming that you've got to pay your cash rent. I'm assuming you've got to pay for your equipment. I'm assuming that you've got to eat. So assuming those costs are in, and you've got another $550 worth of variable cost, corn is too cheap. Corn at $3.50 or $3.40 doesn't put you in the same economic situation. This is the exact same math that triggered the rally a year ago. Now, I'm not saying we're going to $4.13. Please don't come away from that. I think that if it's extreme, this is where the market needs to go if the weather continues to get worse. But the reality is, if you are looking to sell corn, I don't think today's your day, because you've got to make sure the crop is planted. So the futures should move sideways to higher for the next 6 to 8 weeks as the market makes sure that it gets the supply, because you can't have a 4 or 5 billion bushel carryout without us producing a massive crop and planting massive acreage. So maybe this is too high, maybe it's 390. It's got to be above where it is in order to get guys to not take prevent plant. So pay attention to that. Don't sleep on it, because it could become a more important issue. So let's jump right into the charts, because that's why we are here anyway. And I'll start with corn, because corn's been pretty interesting. Now, I wrote yesterday that we follow 4 trend exhaustion signals. So as trend following traders, we want to capture the broad moves. So if you think about it, we want to capture moves like this when they go down. We really don't care about these big sideways moves. Our goal here is just to minimize losses and not get killed. Our goal here is to capture it. Likewise, if it were to move up, our goal is to capture it. So we have to first be able to identify the direction of a trend, but equally as important, we have to recognize oncoming signals of trend reversals. Now, these are not always reliable, and they don't have 100% efficiency. But in this business, anytime you can get your odds over 50%, 50, 60, 70, 80% of likelihood, then you're in a much better position to take a trade. So with corn, I'm going to build these for you because I think it's really important to understand it. I'm going to take a couple of these off, and then we're going to add them back on. All right, so here's corn in its basic state. We have this move to the downside. Here's our first 2 indicators that we follow. We leave these on here all the time, and the reason they're here is to look for this signal. we have a series of new lows, right? And we have a series of lower highs. That's a downtrend by definition. But what we have down here are indicators that are analyzing the relationship over over today's price against past price. You don't need to know the math, but what is important is that when prices are making new lows and these indicators fail to go with it, that's a divergence from price action to underlying commitment of the traders. So they're moving it to lower prices, but with much less enthusiasm than they had prior. So when we see these signals, these are buy signals on upticks. So when you have a day like yesterday, that triggers a buy signal. Now there's two additional indicators that we follow that that carry a really high likelihood of trend ending signals, and this is called TD sequential. Don't need to get into the math, but what it does is it counts down over time. And when you see a 13, that signal's complete and it's ready to, and that's signaling that a low is likely in place and it's a good place to initiate a long position from a speculative standpoint. That triggered yesterday. We've been looking for it for several days. We triggered our divergences 3 days ago. We triggered our 13 yesterday. And then this one is a big one too. We don't talk about waves a lot, but we follow them constantly. So the wave count also completed on Tuesday with a what we would call a fifth wave down. When markets move in fives, now I want to put this in perspective for you. This 5 is showing the completion of a down move that started last June. So from June through the other day, through yesterday, this completed that 5-wave move down at the same time we got a 13 and got a divergence. That's a very powerful signal. And your odds of that being at least a short-term low are extremely high, at least 70, 80%. Now, notice I didn't say 100%. So there's still a chance that that market can turn around and go down. But anytime in trading, you have 4 signals that line up that are historically reliable, that's too overwhelming to ignore. Now, it's done it in May. It's also done it in July. Same set of signals. If you see, you got higher lows on your lower indicators. You've got a 13 and you've got a 5. Now, the only market that hasn't triggered all 4 signals yet is December. And when I flip to December, there's one more difference that's important. This is a 5 here. When I flip to December, you're going to see a 3. So what that tells us is that this is a completed 3-wave down on December. It's a completed move in July. So what follows a 5 is what we call an A wave, or a move higher that's counter trend. And what follows a 3 is a counter trend move of a 4 before a 5. So what the market is setting up for here is a drift higher to sideways in a corrective fashion, to be followed by a new impulsive wave down that will complete a 5 on December. So if you think about it, it makes perfect sense, right? What did we just talk about fundamentally? We talked about that we have to ensure that supply is in place, so we have to make sure that we plant the crop. So we're going to, or should, trend sideways to a little bit higher to make sure it gets in the ground. And then in June or July, once we've pollinated it and the weather looks like we're going to grow the bushels and that supply uncertainty is removed, and if oil's still at 20, then we're going to kill it and we're going to send it lower on a 5th wave down. So the opportunity here is in a 4th wave, which should move in a cadence of A, B, C, 3 waves up, into a 4th wave, potentially up into this area right in here. This is where you want to hedge it. And you want to sell it very heavy because it should make new lows at that point. So from a corn trading perspective, this is very, very interesting and something we want to pay attention to. If you have questions on that or want me to go deeper into it, please call. We love talking about this stuff, and we can go through it. So with that, let's jump to soybeans. Soybeans have the most bullish fundamentals of anybody, but their price is probably the weakest. Why that is, I have no idea. But what this market is telling us is that we want to own a move above 875 in July. And we certainly want to own a move above 897. Um, we are bearish below 875. Coming into the report tomorrow, if we're into new lows, we'll probably, we're in a short position right now on our spec program. We'll probably defend that position pretty early because we don't want to take too much risk here. But expect lots of volatility in soybeans coming up, especially if corn can muster any kind of a rally. Expect soybeans to compete with it and outdo any rally that it has. So this market is primed for a significant move. We can't tell you which direction it'll be. Um, Certainly my bias is that it's to the upside because of the underlying fundamentals, but technically that's not quite confirmed yet. So there's more downside, there's downside risk here, but the upside risk is truly significant. So I'd be very careful and quick to defend a short position. Okay, Kansas City wheat. I really like this market. It looks really good. We've got cold in the forecast. You've got dryness in the Black Sea. We have demand coming in from Egypt, Syria, Iran. You got countries that can't grow their own food, looking to restore and replenish stockpiles. So you've got lots of pent-up demand potential. You've got a supply side issue in the Black Sea, and you've got a potential supply side issue in Kansas if we get too cold. So you could have a situation where declining world supply and increasing world demand in wheat, and that's exactly what we need for higher prices. Technically, this is a perfect setup for a rally. We are above our hedge line. We have no divergences. In fact, this is calling for higher highs because of the strength of the buying. We've held a 50% retracement of this move to the upside, and we are now working higher. A move back above Monday's high of 385 would be considered extremely bullish and put this as a target for the first leg, and likely significantly above that if that market were to move. So a move back down below 463 in July would sour that and kill that reading and move us more back to a bearish standpoint. So lots of excitement could be coming in wheat, which would be a great pricing opportunity for guys to move some risk off the table. If wheat rallies and corn rallies, you should expect beans to rally too. I don't think that they're with their fundamentals and the pent-up demand that should be waiting for that, beans should go with them if they're going to go. So stay safe, trade carefully. As a hedger, I would be looking to hedge on a leg higher. I would not be hedged today. I think we're going to have better opportunities in the future. Now, if we start to challenge the lows on corn, we want to be very careful looking for, this could extend on lower. So if you're going to hedge, I would hedge maybe after we break this low and let it kind of extend and get a blow off bottom. But I don't think that move is going to last very long. So if it does sell off, I think it's presenting more opportunity than it is disaster, at least between now and June or July. So that's the best reading today. Of course, the market can do whatever it wants, but the odds seem to be favoring that is at least a short-term low, and we should be able to move back up into this range here, or maybe even a little bit higher to set pricing with a little bit better levels. So I hope you have a great week. That's all I have for you today. We'll talk to you soon.